So yeah, I'm Carn Cross. Thanks, Luis, for that introduction. And the other thing I do besides Fresh Tracks is I do a couple other things. I am the instructor for the SBA Emerging Leaders class, which I did last year and I'm doing again this year, which is a lot of fun. The SBA selects 20 business owners who've been in business for a while and puts them through a 6-month boot camp, 15 classes. It's actually a lot of fun, and I've really enjoyed that. And Steve Gagner, who started 14 Star Brewery, is actually the SBA Vermont Small Business of the Year this year. Was one of the class members of last year's cohort. So it was fun to get to know Steve. The other thing I do is teach a couple finance classes at the University of Vermont in the MBA program, which allows me to see the incoming potentially young Vermonters, and there's not many of them anymore. So you have probably, if you ever took a business class or went through, and I'm sure went through a SCORE program or so forth, you've probably seen some sort of business life cycle slide like this one, and generally, depending on which academic has produced the actual chart, there'll be 4 phases or 5 phases. Somebody told me the other day they looked at one with 8 different phases on it, and I think somebody was looking for tenure maybe or something, and they wanted to impress somebody in a textbook. But what I always learned years ago was that there were really 4 phases. There was really a startup phase of a business. And that is generally, and some of you I think are in that phase, it sounds like, and you're incorporating and you're trying to get your first product figured out or sell your service to your first customer, that kind of a thing. And then the growth phase of the business is where you begin to have something that's repeatable. Either your product is good and people are buying it and you're making more and making new products, or you found what we refer to as product market fit, and you're able to use that product market fit and some resources to really ramp up your growth, and that's the growth phase. And then at some point, a business gets to a mature phase, and that generally means that growth rate slows down or even stops, and there's some predictability of revenue and earnings. And then there is always a potential for a decline phase in a business. Now, people look at this chart and they think, well, that's what it is. I'm either startup, or I'm growth, or I'm mature, or I'm declining. And just like anything in life, that's a nice curve and a way to think about it. But the reality is, a lot of businesses do this, right? One of their products takes off. There's a lot of growth. Suddenly, that product hits maturity, maybe even starts to decline. They develop some other products or services. They almost jumpstart again. And so throughout a business life cycle, there's this. And then the other thing that I think is really important is that there's almost a myth that there's some point you get to in business in that mature phase where everything is just completely predictable and it's going to go on that way forever. I'm going to make, $300,000 in profit a year and have $2 million in sales, and it's going to go on forever. And I will tell you that in 35 years of doing this, I have never seen that happen to anybody, whether they're a great business person or a lousy business person. There's competition, there's new regulations, there's changes in macroeconomic environment and so forth, right? So all of this stuff means that there are these forces that you're dealing with all the time. So startup growth, maturity, decline. Many, many years ago, I went to a seminar as a young pup, and the gentleman giving the seminar put up a slide that looked something like that, and then said, don't think about that. Here's the way I think about it. He said, there's 4 phases of business. The first one is wonder. And he kind of walked around like, oh, I'm in business. Oh, this is amazing. This is great. And I filed a trade name, and I'm looking for my first wonder. The second phase, that growth phase, he said, that's blunder, B-L-U-N-D-R. What the, whoa, my God, I got a customer, and whoa, and I got more customers, and my supplier can't get me the stuff I need, and my product doesn't work, and right? It's just that growth phase, you are blundering and trying to survive through that. He called maturity thunder. That's when things were going well, and you kind of harnessed the gods, so to speak, and you can throw the lightning bolts and the thunder. There's that. And then in the declining phase, he said, that's plunder. Because at that point, you are either trying to extract all the value you can if the business is clearly going to decline and go out of business. You are just trying to extract all the value you can out of it at that point. That's plunder. The point of this slide, and we're not going to go through all of these things because there's a bunch of stuff on there. But the point of these things is that each phase of a business really requires different types of financing. And that's, I think, the other thing that many business people don't realize is they think, well, I'm going to go out, I'm going to need whatever for capital. And once I've got that capital, that's really it. I'll never need any more capital or any different type of capital. So maybe they go to a bank and they get a bank loan and they say, that's wonderful. But then during the growth phase, they realize, oh, they need even more money. And now they've got to get some. So the reality is, for almost all businesses, there will be this continual need for financing at different stages, and those financings will come from different sources. So I'll just point out a couple here that I think matter. Generally in the startup phase of a business is the highest risk phase for capital providers, and it's also a high risk phase for the business owners and entrepreneurs. And so generally you are looking for capital from sources that are willing to absorb that risk. And so we talk about sometimes the 4 Fs. Friends, go to your friends because they like you, and if any of them have money, maybe they can lend you some money or invest in your business. Family, because your family theoretically loves you, and if they won't invest in you, who will? Fools, like anybody I can persuade to do this. And then the 4th F is really founders. Almost every investor or lender wants the founders to have what's called skin in the game. They want the founders to have something at risk. My rule of thumb for all of you as founders of a business, though, is let's say that you made it to a point in life before you started your business. And that point in your life, you had a little bit of savings, and maybe you had a little bit of retirement income from, or a retirement account of some sort from a business that you'd worked for or a job you've had. And maybe you had some equity in your home. So you've got kind of 3 little buckets there of some stuff, and you're like, oh, yay. Here's what I never want you to do. Take all of your savings, put it into your business. Oh, it's still not quite in that growth phase yet. Borrow all the rest of the equity in your home, put that into your business. Oh, you're still not there. Drain your retirement account. See where I'm going with this, right? Put all of that in there. That's having not only skin in the game, that's putting yourself at such risk that now everyone else that might want to either lend money to you later or invest money looks at the risk that you've taken, and they think a couple things. One is, oh my God, that person is crazy. They took way too much risk. And the other thing is they think that because you took that risk and you've really put yourself in that position, that you will actually be more conservative in operating the business than you should be, because what you're worried about is the fact that you have nothing left, you have no other resources. So I'm a big believer that you need some skin in the game, but you don't need that kind of skin in the game. Think about the farming joke, chicken, the chicken's talking to the pig, right? And the chicken says it's really fun to be involved in the egg business, and the pig says, yeah, you're involved in the egg business, I'm committed to the bacon business. I think you want to be more like the chicken in this. You want to be involved, you want to put a little bit of money in. You don't want to be the pig where you've drained everything you have. So just think about that. I mentioned angel investors. Angel investors are, kind of people that you don't know, but maybe someone you know knows, and you use your network to find them, and those are people that usually have a high net worth. And as a hobby, primarily, it's not a business, but as a hobby, they make some private investments and back entrepreneurs. A lot of talk about them, very hard to find, not as much of that activity as we would like nationwide or in Vermont. Statistically, there's about 4 million people who meet the accredited investor test, meaning their worth is high enough to be able to actually make private investments, and only about 10% of those folks actually make private investments. So a lot of people have a lot of money, but are not about to make a private investment. So just understand that. In the growth phase of businesses, you begin to see banks start to get involved. You begin to see alternative lenders. So in Vermont, that would be county loan funds or county economic development corporation loan funds or town loan funds. It would be the Vermont Community Loan Fund or Community Capital of Vermont over in Barre. Examples of lenders that are willing to jump in early on in that growth phase. So alternative debt. You will see some venture capital. I'll talk about that because that's what I do, but I'll talk about that a little later with a little more detail. And then there's also, in both the startup and growth phase, there's bootstrapping. And is everybody familiar with that concept of bootstrapping? Back in the old days when boots had straps and you pulled them to get your boots on. And basically what you're doing is you're using so an example of bootstrapping would be, you need a warehouse space for your business, initial warehouse space, and you get the landlord to give you 3 months of free rent to start you off. And you get a supplier to give you some inventory on credit, and you get your customers to pay you 50% down on every order they make. And so you're using all of these various working assets that you might have in order to get financing from non-traditional sources. That's the notion of bootstrapping. When you get up into the mature phase of business, no surprise, at that point you've got a lot more possible sources of capital. Banks love mature businesses because bankers like to look, and I was a banker, so I'm now a recovering banker. That was a long time ago. And I go to this 12-step program. It's really funny. I've made it through step 11. I haven't really got to the 12th one. But what bankers like to do is look backwards in order to predict the future. So what they like to do is make a loan to you, and if they looked back at your financial statements for a few years, they would be, in their minds, 100% sure that based on those financial statements, you'll be able to repay the loan. So they don't like looking forward and using pro formas or projections much. But in a mature phase, now they have something to look at. So they really like that. Private equity firms that come in and buy either controlling positions in companies or majority positions in companies, begin to look at mature businesses. That's really what they like more so than growth businesses. Mezzanine debt firms, which are kind of alternative lenders that sometimes will finance the owner taking some money off the table in a subordinate position, and that it can be useful there. And then interestingly enough, even in a declining phase, and you would think, well, who the heck would want to finance a business that's declining? There are a number of specialty finance companies, and banks will even finance a declining company. So banks will use it's called an asset-based, fully followed asset-based line of credit, where they're literally receiving the information on what's been sold, funds that have been collected, what the checking account's balance is, and they're literally truing up the loan on literally a daily basis. And essentially the loan is going down as the business declines if the bank is managing it correctly. So there literally are ways to finance a declining business. You'll also see companies, when they start to decline, say, you know what, the owner says, you know what, I want to get out, it's plunder time, and they'll sell. They'll probably not sell at the high price that they'd like to sell, but they'll sell for something to get out, and the new owner will either take it and try to restart the growth or do something like that. I'm going to just pause here. Does anybody have any questions on any of that? Did I say anything that sounded really out there or something different than you've heard before? Yes, sir.
Names, you were talking about the growth and some of the town and, grants.
Yeah, so I don't think I said grants, although there occasionally, very rarely, are grant-type fundings that can happen. I said economic development corporations in the county. So like in Addison County, I live in Addison County. In Addison County, there's the Addison County Economic Development Authority, and they have a loan fund. And examples of things that they financed pretty early on. The Aqua Vitae kombucha company. They financed that company when it was in Jeff's literally, and he was making the stuff in his basement. That's how early they were into that particular company. So almost every county in Vermont has some sort of, is that a fair statement, Steve? You know as much about this stuff as I. Almost every county in Vermont has a community economic development corporation with a loan fund attached to it. The other thing I said was the Vermont Community Loan Fund, VCLF, which is over in Montpelier, and Community Capital of Vermont, which is in Barrie. Both of those are what are called CDFIs, Community Development Financial Institutions. And basically what that means is the Treasury Department lends them money at almost no interest rate at all, and they turn around and re-lend that out. And because they're getting that virtually free money, their mission is to do things that banks won't do. It's a good way to think about it.
Thank you.
Yes, you're welcome. Any other questions right now? I think we all know what capital is needed for, but you know, generally people need, like I said, they need it all different types. If you're in the landscape business, you might need new equipment and trucks and plant materials and things like that. If you're in a service business, you might need to cover payroll during times when the service drops, and you might need to hire ahead of the service curve to get people on board. So, you know, there's financing needs for a number of things. And in general, if we break down capital into two types, it's either loans, somebody is lending you money, or it's what's called equity, and equity is when it's an investor is taking an ownership position in your company. Another way to think about it is a loan you have to pay back, usually on some sort of schedule. And if an investor invests in your business, you have to figure out a way to get them their money back in a profit. And by the way, as an owner, they have a claim to the share of your profits, and they have a claim to the share of the value of the company if it was sold, right? So you are giving up ownership in that situation. But there's usually no schedule involved.
You might mention that there's an emerging third hybrid, which is the safe.
Well, so yes and no. So I mean, convertible debt, I mean, we go down a rabbit hole of there are definitely hybrid instruments, and I am actually going to mention that have both debt and equity features. They are rarer than, or certainly their use is rarer in Vermont than in other places. But good point, and I will mention hybrids to some extent. I'm not going to go through this in detail, but you know, the difference really between debt and equity I've got outlined there. I will point out though the very last line on this page, which is debt is always going to be less expensive on a pure dollar and cents point of view than equity will be. And you might say, well, wait a minute, I've got to start paying back that loan. It's costing me money, and I've got to take funds out of my cash flow and start paying that back. Yes, but you're paying that back on some interest rate. Maybe in today's market, that's, I don't know, 8% or something. If you give up 25 or 30% of your business for the same amount of money that you could have borrowed at 8%, you will, once you start being profitable and suddenly that owner wants a share of those profits, that can add up to a heck of a lot more than 8% of whatever. So I just want to point out that in my experience, debt is always cheaper. And even though I'm in the business of investing and getting equity in businesses, my counsel is always, if you can do it with debt at reasonable levels, it's going to be cheaper than trying to get an equity investor to invest money. Here's the things that I think that you need to think about if you're an entrepreneur and you're going to seek capital, and I call them the considerations. What do you need to consider before you get capital? So the first thing is, why do you need the money? There are companies, and especially companies that have kind of entrepreneurs that think they're hotshots, that think that somehow or other there's a validation of the business to simply either be able to borrow money or to get investors. And so they kind of search for capital whether or not they need it. And I'm not a big believer that capital is really the deciding factor in whether a business is going to be successful or not. So I don't think that's really a thing to do. So really think about, why do you need the funds? And if you really do need the funds for some valid reason to grow the business, then great. That's kind of consideration number one. Consideration number two is, if you need the funds for something, how much do you need? And it's surprising how many people don't figure that necessarily as precisely as they should. And so they either borrow too little, usually, or occasionally borrow more money than they need, or get more investment than they need. And then the third bullet point is matching the source in the use of capital. So back to that, do you take debt or do you take equity? And let me use my landscaping example, because that's my retirement business in my mind, is I've always wanted to own not a pickup truck, I always wanted to own a dump truck. And so it's going to give me an excuse to have what I wanted when I was 4 years old, and I'm going to get into the landscape business. Of course, that'll never happen. But anyway, let's say I did. So let's say I can find a used dump truck and it's going to cost me $40,000, right? And if that dump truck is going to last me, that used dump truck is going to last me 5 or 6 years, then I could borrow money for 5 or 6 years, and I would be kind of matching the source to the use, and the truck would depreciate and its useful life would go away, and my loan would be paid off at the time I was bringing the truck to the scrap heap. And that would be a good match of sources and uses. If instead I went to Uncle Harry and said, hey, Uncle Harry, I'll sell you 40% of my business for the price of that dump truck. And Uncle Harry, for some reason, said, sure, that's great. That's kind of a dumb deal for me, because now I have an investor who owns part of my company for eternity, potentially. And yet my truck that I've used it for is going to be worthless in 5 years, right? So matching the source and the use is important. And then the industry you're in is also important. We got a lot of different types of businesses here today, from small sole proprietorships and folks that are in service businesses versus product, and we've got an ag business from the sounds of it. And all different industries have different types of lenders and investors that are interested in that type of business. So there are banks that love some kinds of businesses and not so much others. So in Vermont, there will be some banks that say, we don't do any agricultural lending. And there will be other banks, and other, Yankee Farm Credit would be, an example of an actual, farm credit company. That's what they do is farms, right? And so they specialize in various things. So it's important to do the research based on your business and industry, to have some understanding, so you're not approaching the wrong lender and really just wasting, your time, because they'll say, oh, sorry, we don't do whatever. We don't do food product. We don't do restaurants, right? This kind of thing. Anytime you have borrowed money or you've taken an investment, you have to figure, it's now somebody else's money, it's other people's money, and you have to have a plan as to how you're going to repay that money. And if you don't have a plan, don't take the money, because it will cause you great problems down the road if you, for some reason, think that, oh, I'll never really have to pay back Uncle Harry. I guarantee you at Thanksgiving, you won't have a great time with Uncle Harry, because he'll wonder where his payments are and wonder where his money is. So you got to figure out how you're going to repay or cash out. And then everybody has to have a plan B. And the plan B is really, if I can't borrow money and I can't find an investor, can I still be in business, and what's my plan to do that? And I think that's the way you should really operate, like when you're thinking about your business model, and when you're thinking about anything from expansion to startup to expansion to mature business, is what's my plan B? If this happens and this happens, what's my reaction to that going to be? And in the companies we finance, I'm always saying to the management team, you need a plan B and a plan C and a plan D, because life goes wrong, things happen. And many times you are doing plan B, and then sometimes plan B doesn't work and you're struggling with plan C. So you really need to kind of think that. And then the final point, because my business partners accuse me of thinking I'm a sociologist rather than a finance person, and they're right, they're right, is that your relationship with who's ever financing your company, whether it's an investor or a founder, some part of that relationship is going to be based on needs to be based on chemistry. And by that I mean, do you like that person? If you're borrowing money from somebody or from an institution, or you're getting investment from somebody or an institution, do you like the counterparty you're dealing with? And are you going to be able to deal with them for many, many years? Do you like to spend time with them? Do you like the way they treat you? Do you like the way they've treated other people? And a lot of people, a lot of entrepreneurs will say to me, well, it's really just all money's green, right? All money's green. And I will say, that's not true. I've done finance and business deals with other investors and lenders who I would never do business with again now that I know what I know, right? And so figure out this chemistry. It's not like a bad date that you can get out of. It's like a marriage that's going to last for some period of time. And do you really want to get up and see that person every single day for the rest of your time together? Think of it like that, because it's really more like that than it is like anything else. You know, equity investors is really like, how do I think when you know, we're looking for chemistry also. We're trying to figure out risk and reward, and we perform what we refer to as diligence, which is where we're really digging into everything in the company. Yes, sir.
So just before you get going, if debt is cheaper, then why would people come to? Is it because it's harder to get?
Yeah, sometimes there are lenders, sometimes a business is just not creditworthy, and they can't borrow money from anybody. Nobody will lend them the money because the lenders think it's just too risky, and they can't figure that out. I'll talk about kind of lending profiles or how lenders think about it in a minute. But we, you know, this slide is really kind of how we think about it at a very broad level when we're evaluating a business to invest in. This is actually, so this is the way, when I was a banker many years ago, it's the way I was taught to think about things. Steve, you were probably taught the same thing. I had young Matt Bradley speak to my, you'll love this story. Matt Bradley speak to my MBA students, and I said, Matt, I want you to come in, I want you to talk about lending money to businesses, and I want you to kind of use the 5 C's of credit as your approach. And Matt said, what are the 5 C's of credit, right? And I'm like, oh man, I'm old. This is. But then when we talked about it, he actually said, because he's a great young guy, and he said, you know, once I got into it, he said, I went and asked Willie McKinnon, because I figured, you know, Willie's our age, right? So I went and asked Willie, and Willie told me all about what this was, and then I realized, well, this is what we do. It's just we don't call it that. But basically, when I was taught lending, when you were evaluating on behalf of the bank, you were evaluating a borrower. You looked at character, you looked at conditions. I'll explain each of these in a minute. Capital, collateral, and capacity. And character was really the willingness of somebody to repay the loan, and it's just what it sounds like. It's really the character of that person, the integrity of that person. This can be difficult to talk about today because some of the problems with using character would be that banks and bankers tended to lend money to people that looked just like them, that their families had known forever, right? And so you ended up having a banking system over many years that really didn't serve the public well. So one reason we may not talk about character anymore is that it led to things that I don't think really made a lot of sense for the community and the economy. However, the willingness to repay is an important thing to understand. And generally, most lenders use For a startup business, since there's nothing to evaluate there except the founder, they'll use the founder's personal credit scores as some indication of how they will handle their business debt. And I only mention that because I especially mention this to young entrepreneurs, because a lot of young entrepreneurs are like, yeah, you know, my credit's great, except I'm not really making my student loan payments the way I should, right? And so, you know, I just want to, you know, handle your personal credit well. That will count toward a bank loan. I know that to be true. Conditions are, you know, that can be the economic conditions. Are we going into a recession, or are we going to continue to have growth? It can be the actual way the loan is structured. It's basically both exogenous and other factors that can be controlled. That can be that's either that the business will either have to react to, or that the lender can place certain conditions to kind of control things in certain situations. Capital is really the skin in the game. Even a lender wants to see an entrepreneur have some skin in the game before the lender lends. So that's what the capital C is. Collateral is, hey, what am I going to grab and liquidate if they can't repay? So in my dump truck example, the lender would take a security interest in my title to my dump truck, and if for some reason I didn't make my payments, they would bring an even bigger truck in, and they would grab it and tow it away, and they would sell it at auction and hopefully recoup some of their money. And then capacity is that backwards-looking thing that I talked about, where they're really looking backwards to say, does this business have the capacity and the cash flow to really repay the loan on the terms and conditions? So that's really the way that they look at it. And a lender is always looking for secondary sources and tertiary sources of repayment. So the primary source would be business is making money, business makes the loan payments. Secondary sources, hey, if the business can't make the payments, grab the collateral, liquidate it, and pay the loan off. The tertiary source is, if you've grabbed the collateral, they take my dump truck to auction, and it only fetches half of what I owe. The tertiary source is, they're going to have asked me to personally guarantee that loan, and they're going to come back after me and try to grab something else that I own. And what I've seen banks do in some cases is say, okay, well, we know you don't have anything else, but we are going to go to court and basically get some sort of judgment, and if you go back to work for somebody again, we're going to want to attach part of your paycheck every week for the rest of your life to pay off the rest of that thing, right? That's called a personal guarantee, and all banks will want you to have a personal guarantee. So that is the you're getting it cheaper because it's a bank loan, but the personal guarantee is some risk for you. Questions on any of that? Yes, sir.
So on the collateral side, how do they look at it when you're in research and development or pre-prototype development?
Yeah, they look. My snarky answer to that from a lender's point of view would be, oh, they're going to say, well, you don't. There's really nothing there. You don't have anything yet, because they won't value intellectual property. So so kind of to the question that was asked before, that a company that is doing R&D around a technical product and then going to perfect that, come up with a minimum viable product, test it out on beta customers or whatever it might be, and then roll it out into production, is probably going to have trouble getting debt financing at the beginning, and that's where it will be, hey, we can't get that. We have to find equity investors if we need capital. Or, I don't know if you're familiar with SBIR grants, the Small Business Innovation Research program. There may be ways to get grant funding for that type of a startup to get you to a phase where you have a real product and real customers, and then you could actually borrow money from a bank, potentially.
Thank you.
So how long of a track record do you need to get a decent loan from a bank, roughly?
Well, it depends. Those alternative like a loan fund and the alternative lenders that I mentioned will go in very early. Literally, in some cases, even finance startups. For a bank, it's probably these days it's probably 3 years of track record with at least one or two of them being profitable in some fashion. and it probably is even longer than that. I don't know. What do you guys see in the market, Steve? 3? Yeah, 3. Yeah, okay. Question over there.
I have a question. What is your opinion on, let's say, businesses growing organically while building a fan base? What's your opinion, like taking a loan to take business to, let's say, 10 notches up as a bigger business, or organically slower growth but no loans? What have you seen success versus failure rate that businesses see either way?
Yeah. So the questions I would ask if I were you in that situation is, if I don't grow more rapidly than I can through organic growth, are there competitors that are going to come in and position themselves around me so that I will eventually not be able to grow anymore at all? In other words, do I have to grow faster to stay competitive? So that's a question to ask. Another question would be, how sure am I that by taking capital I can actually increase my growth rate? Yeah. And that also may be, can I find the people? I'm going to have to hire more people to grow. And can I find people that are really well trained? And so there's like a bunch of other factors, I think, that go in there that you have to really wrestle with.
It's actually hard to find. So.
Yeah, and I hear that in Vermont. I hear that from everybody trying to grow rapidly. Is I can't find enough people that are skilled enough to do that. But I always think that, and again, I'm a believer that there's no kind of mythical growth rate that will protect you in all situations, because there are competitors that are always out there and new products that are always disruptive. And sometimes you have to grow rapidly in order to keep them at bay.
Right. Well, it's a service-based business, so there's no like a specific physical product.
Right. But the same thing would hold true, though, right? And for the most part in service, where you got other more ruthless competitors and they're nipping at your heels, and if you don't stay ahead, they're taking market share from you.
Because I've seen some businesses that they try to grow too fast, they take out loans, and then they don't have enough customer, or other problems arise that they fail altogether, or or they end up in like debt that they can't like pay properly.
Yeah. You can grow yourself broke, which is a concept that a lot of entrepreneurs don't understand. Well, if I'm growing, then everything's going to be good. You can get yourself into a situation where your growth rate is so rapid that your balance sheet, your assets really can't keep up with it, and if you get overloaded with debt, that's another extra nail in the coffin, so to speak. Other questions, kind of on this topic?
How do you come up with a business valuation? Are you going to talk about that later?
Do we have a dartboard? I could talk about that. Happy to, yeah. Let me just see where I am, though. I've talked about, let me go through this and then let me deviate and talk about that. Because I'm not sure I get to it in here, and it's actually an interesting subject. So these are my rules for raising capital, In this day and age, people, I used to like write a white paper or write an article or do something, and nobody wants that anymore. They want 10 bullet points, right? And so, in order to do that, I'm like I'm going to just come up with my rules of raising capital. And the first one is the golden rule, and I always ask this question. So if you've ever seen me do this before, don't answer but if you haven't, so the golden rule, everybody knows the golden rule, right?
Do unto others.
Yeah, so when people think about the biblical thing, that's not the golden rule of raising capital. The golden rule of raising capital is, if you have the gold, you get to make the rules. And so inherently, there's an imbalance between someone who has the gold and someone who wants the gold. And I think it's really important for everybody, and I've been in both positions, it's really important for everybody to understand that if you want capital from somebody because you don't have capital, that capital provider is going to put some rules around that you may or may not like, and it's going to be up to you to negotiate as best as you can and then live with the result if you need that. The best time to raise capital is when you don't need it. That sounds like a paradox, but it's true. And the most egregious examples, which I've had happen in my life, are, a company that we have financed, and all of a sudden it's Wednesday, just like today, and their payroll's due on Friday, and I get a call at 5 o'clock on Wednesday saying, hey, we're not going to be able to make payroll unless we can get another $25,000 loan, right? That is not a good time to raise capital, right? The answer to those kinds of situations is almost always no. Or if it's yes, go back to bullet point number 1. It's yes with some really onerous penalties that nobody wants, right? And so, in a startup business, that means if you're really going to need capital for your startup business, you've really got to start that process long before you're going to need it to be able to find the capital. And then I always think that you should be thinking a capital raise ahead. So even when you've got your startup capital, be thinking, okay, if I start to grow, I'm going to need more capital most likely. Where am I going to go to get that? And should I start talking and building that relationship now? So you got to think a capital raise ahead all the time. That's what I mean by try to raise capital when you don't need it. Right size the capital raise. That's back to, if you need a dump truck and it's $40,000, don't borrow $100,000, or don't confuse right sizing with raising capital when you don't need it. Hey, I don't need $100,000, but I'm going to go get 100 because I really need 40. Get the 40 when you need the 40 because you've started the process ahead, and then start the process for the next piece of capital ahead of the time you need it, but don't take more than you need. Any kind of raising capital, whether it's loans or whether it's equity, is the first step to losing control in your business. I'll say that again because people are like, well, I'm not selling any of my business to the bank. Hold on. The bank's got the collateral that I mentioned. And if I'm in my landscape business and my truck is necessary and they come in with the big repo truck and grab my truck, I am out of business, right? I've lost control of my situation. So any type of capital is the first step to losing control. That means you have to live with that ambiguity if you're using other people's money. And again, I've been in that position, and it's a very, you at first you're like, oh my God, and then you have to figure out, I need to get used to this. I need to understand that I'm not in complete control of everything. If you borrow money, you gotta repay it. You're borrowing it. They're not giving it to you. If you get investor money, you actually have to figure out some sort of exit plan for those investors to get them out at some point. Loans are more, I said all of this was a relationship and you wanted to have chemistry and all that. I will say that loans typically are a little more transactional. Equity is always a relationship. If you sell a piece of your business to somebody, suddenly you have actual legal duties to them, but you also have kind of the moral duties of having to talk to them and take their phone calls even when they're uncomfortable. So those are the golden rules. So we'll hop to valuation because it's a great question. And I'm not a valuation expert, even though I've had to place a value on some companies. A valuation always assumes a willing buyer and a willing seller in theory, right? And so you start from that premise. There's kind of three rules of thought, I think. One rule of thought is in finance, there's a discounted cash flow of an assumed terminal transaction. And what that means is, hey, I think my business is going to grow based on my financial projections from here to here in 5 years. And that means in 5 years, given that, and I look at other businesses like mine that have sold, I'm able to say, oh, they sell for 2 times revenue, and my implied revenue in 5 years is this, times 2 is that, discounted back, based on a discount rate that is arbitrary. That means today the value is X, right? So there's it's a wonderful, finance geeks love that thing because it's all, and if we tweak it here and tweak it there, it'll be this. What if the market moved to not be 2 times revenue, it became 3 times revenue? What would that be? Or what if we change the discount rate? it's all theoretical, and it almost always is completely wrong, right? Because nobody hits their projections. Business valuations overall change based on willing buyers and willing sellers. So all of those assumptions are not necessarily right, but they're at least an indication potentially of some potential value. So that's one. That's one piece of it. The other is simply comparable sales. So if you have a company that makes a potato chip, we'll just say, there are a lot of companies that make potato chips. Let's say you're making a potato chip snack food. It's a small local and regional company to begin with. Can you look at other potato chip companies around the country that maybe have sold to a willing buyer and look at the metrics there? Oh, they sold for $200,000 and they had $100,000 of sales, so they're selling for 2 times sales. There's 3 transactions like that around the country. Oh, yay. My company's probably worth 2 times sales. That's a comparable sale today, not anything in the future. That's a great way to do it. The problem is there's an imbalance of information accessibility. So if you're an entrepreneur and you're trying to figure that out, how the heck do you track down all of the possible sales that there might be? It's possible to do, but it takes a lot of time. Then there's a combination really of those 2 things, which basically takes a look at that comparable piece, but factors in the growth rate that's expected over time, and performs really a different calculation. And that's used for startup companies a lot, and it's actually called the venture valuation rule or some wacky thing like that. And again, that was an academic that came up with that. I've seen that applied more in technology companies than anywhere else. I'm not sure that any of it has really, you're always figuring out valuation in something like this on the front end, and unless you track all the way to the final result and then map it all back and really do that kind of data analysis, it's difficult. There are companies that specialize in gathering this data and then do valuations, and you can get a pretty good business valuation digitally from a handful of players. One of them is called Scalar, S-C-A-L-A-R, for a couple $1,000. And they have access, so they can literally go, okay, we'll take your projections, we'll go through our database and we'll find 20 other companies or 10 other companies or something like yours that have had transactions. We'll use that, we'll do this other stuff, they've got the sources and they put it together. So it's
Don't forget, I don't want to go further off track, but there's also the balance sheet valuation. I don't know if that gets used a lot anymore, but that's another tool.
Right, that's a really good point. It's a really good point, Steve. And then the other, as Steve said, the other valuation is you got a balance sheet, and your balance sheet has a book value. Assets minus liability is your equity or your book value of your equity. And so if your assets are worth more than your liabilities, there's some inherent value. Generally, I would say if I was selling my business and all I got was book value, I was probably doing the plunder after it declined. It was just like, just give me whatever I can get. I would hope that I could sell it at a point where it was worth more than the sum of the assets minus the liability. But good point. Did that answer your question? So if I gave this talk 20 years ago, it would have ended now, or even before now, right? But what's really interesting about the times we live in, which has a lot really to do with just kind of digital access, is that there are a lot of other ways to figure out how to finance companies today that exist today that didn't exist even 6 or 7 years ago. And so there are a number of business plan competitions out there in the big wide world. Now, if you've got a local potato chip company, maybe there's not the right business pitch competition for you. If you're working on a interesting, potentially, technology application or something, there could be a business pitch competition that works for you, nationwide. And I threw up some examples. Mass Challenge is the largest. It's in Massachusetts. That's why it's called Mass Challenge. They take 10,000 different applicants, they winnow them down to 200 or 300. They work with those 200 or 300 over the course of 6 months. They assign them mentors, and then they select, I think, 50 winners, and the top winners get $1 million, and the lesser winners get $50,000. We've had a couple of Vermont companies that have made it through that process and actually, gotten some capital. Here locally, we have the Launch VT business pitch competition, which goes through a similar process, but not with 10,000 applicants, but with 30 or 40 applicants. And then my firm has run some events that we created, the chairlift pitch, peak pitch, and then the motorcycle thing that I created because I wanted to get my partners to pay for me to ride around Vermont on my motorcycle, and it worked for 5 years. Although we're taking a break this year, we're gonna come back next year, but we're taking a break. You can also go to, I mentioned angel investors, and you can actually now find angel investors via online platforms. So it's actually become an easier potential way, and so 2 of them are Gust, and another one is called Angel.co, or it's really Angel List, and there's more. There's probably a dozen other ones. There's actually one, and I'm spacing out on the name, but there's one that's actually really the place to go for food, to find food product angels, interestingly enough. There are platforms, there are different ways to connect directly with investors, nationwide. You can also bypass angels today and use crowdfunding platforms. It's not equity, it's not debt. It's technically revenue to your company, but you're either pre-selling your product by using Indiegogo or Kickstarter or one of those platforms. There's probably been 50, maybe 75 Vermont companies that have launched and gotten up and running using Kickstarter it's usually a physical product of some sort, but they've run a successful Kickstarter campaign and taken in between, I don't know, last I checked, the most anybody ever raised on Kickstarter in Vermont was maybe a couple $100,000. It's relatively serious money for a small startup. So that exists today and didn't exist 10 years ago. We talked about bootstrapping already. And then you can crowdfund in a different way. So Kickstarter's crowdfunding, but it's non-equity based crowdfunding. There are equity crowdfunding sites. The Vermont specific one is called Milk Money, milkmoney.com.
These people don't need to be accredited investors, right?
So the Milk Money site is open to anybody. Yeah, I've used that word once and then you just use it again, so let me define that. So many, many years ago, after the Great Depression, there was what was called the Securities Act of 1936. And what the Securities and Exchange Commission, or its predecessor, whatever it was back then, was trying to do was protect the public from con artists that were literally running around the country selling shares of fake mining companies in Alaska and all kinds of crazy things to the unsuspecting public. And so after the Great Crash, they created a whole bunch of securities laws, and what they decided was, in order to invest in a private company, not a publicly traded company, but a private company, which inherently will be illiquid, meaning you can't take your shares and go sell them to somebody else, and there's no market for your shares if you've invested in them, that they would limit private investing to people who had, and back in 1936 it was $1 million net worth is basically what it was. So if your net worth was $1 million or more, you were an accredited investor. That's it. You didn't have to be sophisticated or know anything about investing. You just had to have a net worth. And the reality was, what they were saying was, well, if somebody had $1 million in 1936, they can afford to do whatever they want. So if they lose their money because they don't know how to invest, who cares? We don't have to protect them. And that allowed an exemption for private companies to go raise that kind of capital. And that law existed all the way till, well, still exists, but it got superseded in 2011 by the Jobs Act, which was a piece of Obama legislation. And everybody thinks the Jobs Act was about jobs because we name bills today in interesting ways that have nothing to do. But the Jobs Act is jumpstart our small business startups. That's what jobs stood for. And it was basically a crowdfunding legislation. And the theory was behind it, because private investing was limited to people with a high net worth, members of the general public weren't able to access some of the great wealth-creating companies. And the example that was used many, many times in all that federal testimony was Facebook. You know, the Facebook investors were all rich people and, you know, institutional investors. You couldn't just buy a share of Facebook, but boy, if you could have bought a share of Facebook, you know, as a regular Main Street investor, that would have been a really great investment, but you didn't get a chance to participate. So the idea was that you could create these equity crowdfunding platforms to transact business. That was in 2011. Congress charged the SEC with writing the rules, so they created a law. You know, there's lawmaking and rulemaking. They created a law, and they said, okay, SEC, you got to write the rules, and we'll give you to mid-year 2012. In 2017, maybe it was 16, the rules finally got written to the point where people began creating some crowdfunding platforms. And so we've really only had a couple years of experience in doing this. And I would say that there was a lot of ballyhoo about leveling the playing field for Main Street investors and a bunch of stuff. And it really hasn't proven true because Congress really forgot one thing, which is the average Main Street investor doesn't have a lot of money to invest. And so just by having access through a crowdfunding platform didn't necessarily mean people had a lot of money that they were going to invest. So it hasn't really worked the way I think it was intended, but those platforms exist, and there have been Milk Money, I think, in 2 years has raised money for 6 companies, maybe 7 companies in Vermont. So one of their better examples is the people who make the backyard maple evaporator out of a 50-gallon drum. Have you guys seen those? It also doubles as a barbecue. You can swap out the pan. You swap out the pan for like a grill, and it's your barbecue in the summer, and it's a sugaring pan in the winter. It's a cool little thing. Yes.
What kind of regulations do these funds have for interest rates?
So that's an interesting point. On the crowdfunding thing, you create your offering with some legal advice, and then see if you can sell it. So it's been interesting. The offerings that have worked on Milk Money, and this is pretty transparent. You can go to Milk Money and actually like read. All you got to do is give them your email address, and you can read what the other offerings were and whether they were successful or not. So you can actually get quite a bit of information. A number of the offerings were, successful with, and they're really debt offerings rather than equity, with relatively low interest rates, 6-7%, and not an equity position. So it's kind of fascinating, and they, most of the, I think the evaporator company maybe raised $75,000 or something like that. It wasn't a lot of money, but it was enough money to get them into business, right? Yes.
So I got a question about giving up equity. I mean, it sounds scary, but I'm wondering if sometimes it may not be a good thing. I mean, you talked about it like a marriage, right? And I mean, I've seen too many TV shows like Silicon Valley where venture capitalists seem really scary to work with.
Really
yeah,
we're not. I just want to say.
But a marriage, if it's good, it's great, and if it's terrible, it's terrible. And all TV shows are always about the bad ones. But
I've had one of each of those, by the way. Not a TV show,
but presumably when it works, right? Not only do you get money, but I gather you get advice and
yes,
right, like useful feedback. You get a loan from a bank, it's like you get the cash, that's it. But am I right?
A good banker you can build a relationship with, and they'll give you some advice. You got to work at finding a good banker. And I would say as banks have gotten more and more automated and more consolidated, the commercial bankers or business bankers are overworked, and they've got a production quota to meet, and maybe they can't spend as much time with you. Theoretically, an equity investor would bring more to the table, and the way we think about it is we have a great network of recruiting people to help a company to add. You're going to build your team. you know, we can tell you people that we think you should hire who maybe we've worked with in the past. You know, want introductions to various folks for sales contacts, let's work our network and try to figure out how to do this. So all of that stuff should be true with a good investment firm. Having said that, an academic that I like actually went out and did a study in which they asked venture firms across the country what was, in order of importance, what was the most important thing that they did. And all of us as venture capitalists were like, well, the money's really last. It's about our network and our connections and our advice and all this other stuff. So we ranked them like that. And then they asked entrepreneurs that had received money. And it was exactly the opposite order, right? All the entrepreneurs are basically like, all I care about is the money. Their advice is ridiculous, you know, by and large is ridiculous, right? And so when you looked at that statistics across like thousands of transactions nationwide, it was almost a complete flip. So I think, you know, like you go to our website and we've got quotes from our entrepreneurs that are like, oh yeah, everything's really great. And I don't know, maybe they felt they had to give them. I don't know. I think we're okay, but you know, and I've never tried to do that kind of blind survey with our companies. But I do know nationwide it's different than what might be expected. John?
Just real quick, I'm a former entrepreneur who took money from a venture company, and I can say that for me, it started as, it was just the money, I needed the money, right? But eventually I sold my company, and that venture company put me in touch with business brokers who I would have had no way of finding on my own. And the sale was beneficial to the venture company and to me. And I got a lot of good advice from her. So when you start out, maybe your opinion as an entrepreneur is one thing. You may end up in a different place then.
Yeah, I would agree with that. I think that's true.